Assalamualaikum and salam sejahtera. Welcome to FAR160 lecture series, and this video will cover a subtopic of partnership, that is the changes in partnership. One of the changes is dissolution, means that you stop or totally closed out the partnership, so they call dissolutions. So partners may decide to terminate the partnership. They don't want to continue with the partnership anymore. So once they want to terminate the partnership, you need to prepare a realizations account. It's called realization accounts, and those assets and liabilities that are still available or exist should be transferred to realization account, where the assets, all the assets and the liability, the assets are sold off, except for cash. Of course, you cannot sell off the cash. And the liabilities, once you have the cash, so you need to pay out all the liabilities that are due, that they are available. I mean, the debts that you owe to other people. So you need to pay all of the vendors, the suppliers, and also the lenders first, because we want to find is there any balances in the realization account where you will debited the debt. I mean, you already settle off the debt, and also what are the recipients in the cash, what are the recipients in the cash once you sell off the asset. So any balances, whether it's profit or loss, then those balances will be transferred to the partner's capital account using the agreed sharing ratio in the agreement. So whether it's a loss or it's a gain. So then any balances from the partner's account, also partner's current account, also will be transferred to capital account, just like the balances from realization account will be transferred to capital accounts. And if you have a credit balance, that means that the business still have money to pay to the partners. However, if the partner's capital account is a debit balance, so the partner need to pay the business. Means that you don't have enough cash to pay all the debt. So you need to pay. I mean, the partner need to pay to the business. So if one of the partner do not have the money, so we call it a partner is insolvent. So we have to use the Garner versus Murray rule. This is a law preceding case. So whereby in the Garner versus Murray rule, the other partner need to pay, need to contribute more. I mean, sharing the insufficient money to pay the debt, to the debt of the third party. So these are the steps once the dissolutions or the termination of partnership. If the partners agreed to terminate the partnerships, it will take a long time actually to process. I mean, to go to the process of dissolutions. For the retirement or new partner to the partnerships, it also called as a changes to the partnership. So you need to have a revaluation account whenever the retirement or new partner entered to the business, the partnerships. So the revaluation account is actually assets are revalued, whether the current value of those assets has been increased or decreased. However, the revaluation account only for the old partners, I mean the existing partners, not the new one. And the profit or loss of that revaluation account will be transferred to the partner's capital statement. Okay, goodwill account. Goodwill account is actually the fair value of the business asset, which is exceed the net asset book value, what you have record, probably less than the actual or the fair value, the view of people, the view of the people, what are the value of the business. So it's sort of what are the people view of your value. So however, the goodwill is not easy. I mean, you just can't take whatever the amount of goodwill. No, actually, you have method to measure the goodwill. We will discuss it later. So for the revaluation account, let's say the example like this: the freehold land has a carrying value, means that the existing value is 3 million. However, the new value becomes 3,400,000, and the motor vehicle decrease from 160,000 to the new value is 140,000 only. Same goes the account receivable. The carrying value in the financial statement, the last year financial statement, accounts receivable is 170,000, but now at the point of you revaluing the asset has been reduced to 120,000. So let's say Ani, Ayu, and Arif sharing profits of losses 3, 4, 3. Means that 3 Ani, 4 Ayu, Arif 3. It says here that if you revalue the asset, so increase value of asset, you debit asset and you credit revaluation account. And if there is a decreased value of asset, so you will credit asset account and debit revaluation. So let's look at the example. Let's look at how do we calculate and record revaluation account. So we will prepare the revaluation account. Remember, when we say account, it will be a ledger. So you have a title of date, particular, debit, credit, balance. Right? Okay, now it says here the freehold land, the balance, I mean the carrying value, the carrying value is the balance, is 3 million. Now the new value is 400,000. So let's say we have the changes in the partnership is on the 1st of July. So July 1st, okay, when there is an increase, so it should be debit your asset, right? So your debit 400,000 because it's increased in value of 400,000. So the new balance will become 3,400,000. So this 400 is actually will be transferred to revaluation account. So your particular will be put revaluation account or just revaluations. So in your revaluation account, so the date is July 1st. So this is for the freehold account. So when it's here debit, of course, the revaluation will be on credit side. So next is motor vehicle. So motor vehicles, again, the revaluations will be on the 1st of July. So again, it will use the revaluation account And now the amount, the value of motor vehicles is actually decreased. So decrease means that you credit the asset. Okay, 160 minus 140, so of course it's 20,000. Forward the comma. So the balance, the new value should be 140,000. So credit on credit side, we record on credit side of motor vehicle account, of course, in the revaluation account would be on the debit side. Same goes with the account receivable. Again, account receivables, it reduced 50,000. So the new value of account receivable should be 120,000. Again, your revaluation account have account receivables that will have the value of 50,000 on the debit side. So if you look the balances of revaluation account should be add with the credit or add with the debit, doesn't matter. So, but however, the credit side is more than debit side, so usually backward to the positive amount. So the balance actually, after you revalue freehold land, motor vehicles and account receivables, the value of the surplus amount, there is a surplus amount of 330,000. The surplus amount. So this as a surplus amount will be shared among the existing partners. So it will be sent to partners capital account. Partners capital statement. That is partners. You have Ani, Ayu, and Arif. So since this one is in the revaluation accounts, okay, this balance is actually on credit side. So your distributions of the surplus should be on the debit side. So since Ani is the sharing is 3 out of 10, so it's 30%. So the surplus will be multiplied with 30. Ayu sharing is 40%, and Arif is the sharing of 30%. So actually, sorry. So in the end, your revaluation account should have the balance of 0, because you will not keep the valuation account in the book. You will transfer all of it to partners capital account. Okay, that is how you actually make the valuation account. But however, in the exam question, if they ask for revaluation account, then you do this only. The top one, the revaluation account. You do not need to open up this asset account because it's not required. So do not waste your time. I show you in the video just to know why the 20,000, the 50,000, and also the 400,000 on the credit side and the debit side, because it's apply the rule of double entry. Okay, next we moved on to goodwill account. So there are actually three methods of measuring the goodwill in the business. First is using the method of we call accounting profit. So the formula is actually the value of the average annual net profit and multiply the years of purchase of the net profit. So years of purchase is actually the determinants of the number of years for that particular goodwill. So it's just some value of judgment, or the partners agree what are the years of purchase. The second method is using super profit, where the value of net profit, after taking considerations the salary paid and also interest paid to the capital has invested to the partners, and then you will have a value of super profit multiplied with the years of purchase. Again, years of purchase is determinants of number of years the goodwill has been accumulated. Okay, then the third one is using the sharing ratio. What are the profit or loss sharing ratios of the partners? Usually these are based on the premium paid by the new partner, the goodwill premium that has been agreed by the new partner to contribute to the business. So it's more or less what are the new partners see his contributions to the goodwill of the business. So let's look at example how we actually measure the goodwill using accounting profit method. Okay, let's have an example like this. So Arini, Alana, Aida, and Arif are partners in the partnership using this, and they sharing the profit and losses equally. So each of them is 25%. So on the Arini's retirement, so Arini retire means they quit from the business, the partnerships. So they agreed to value the goodwill of 2 years purchase. That is the number of years they agreed as the year purchase, and then of the average net profit over the last 5 years. So we have here the net profit is in 2019 200,000 and 190 and so on. So you need to calculate what are the average net profit for that 5 years. Okay, let's calculate the amount of goodwill. So first we need to have the average net profit. So of course you will add all those the net profit. So we have 2019 200,000 until the 2015 is 160,000. So you can use in Excel you have the average formula. So you put all of it. So the average is 160,000. So the goodwill amount, so your goodwill amount is actually the average 2 years of purchase. So it means that the 2 years of purchase multiply with the average profit, average net profit that we have calculated. So now the amount it is actually 2 multiply with the valuation profit. So this is the amount of goodwill. So in your goodwill account, okay, the tips to remember how to do the goodwill accounts. So you will have the particular partners capital account. Okay, partners capital account. You need to distribute the goodwill calculator among the partners. Okay, first you need to credit the goodwill account. Okay, so now on the debit side of goodwill, using the profit sharing ratio that they are using 25 each. So the goodwill is 32,000 multiplied by 25%. So the same with the amount. So actually your balances would be 320,000 plus this is the amount, the balances of goodwill account. However, the goodwill account should not be maintained in the business book. So you need to counter to record it, counter record it. I mean, to making sure that the goodwill account at the end of the balance, because the goodwill is on the valuation on the, let's say, the 1st of July. So in 31st December later on, you will not have balances of goodwill account to be brought forward. So you need to close it out. So the next thing you do is using the capital partners account. However, at this moment, you need to use the new ratio. Oops, sorry. The new partner sharing ratio. Okay, so assume the sharing profit and loss equally. So just now is 25%. So now you just divide by 3, because only Alana, Aida, and Arif still exist in the new partnership. Okay, so you need to credit the goodwill account and debit partners capital statement later on. So it will divide it by 3 because you have 3. Okay, so this one HRD only should have only 2 decimal point. Okay, number, reduce this to 7. Oops, sorry. Reduce this. Okay, and again, is this the same with this amount? So later on in your partners capital account, you will credit Arini partners capital Arini 80,000, and then on the debit and you will debit Arini not Alana on the debit side. So later on you will have your capital or partners capital statement will be changed due to the goodwill arise. And your goodwill account again, just now I told you it should at the end would be 0. Okay, That's how you are using the accounting profit method. Now let's have a look the next method, super profit. For super profit method, let's use the example. Zaidi Zaman Zila, the sharing ratio is 334, and Zila retired on 1st January 2020, and net profit for financial statement ended at 2019 is 150,000. So the total salary paid to this the partners is in 2019 amounting to 30,000, and capital invested, I mean, all the capital has been invested by the partners is 100,000, while the return on capital employed usually will be derived from the market. You can look into the business page business pages on Malaysia, and also in Bursa Malaysia. So you got the accepted value of capital return on capital employed for the year. So let's say return on capital employed is determined as 20% per annum. So those these are the data that you need to have if you want to use the super profit calculations or super profit method to calculate the goodwill. Okay, so the value of the goodwill was taken. I mean, they decide the value of goodwill is with the 2 years purchase of annual super profit. So your calculations just now on the net profit is 150,000, and the total salary is 30,000, and the return on capital employed ROCE is 100,000. The capital has been invested, and multiply with 20%. So that is the return on capital employed. So you need to less the salaries and less the return on capital employed, so that you will become you will have the figure of a super profit. So when you have this super profit, you will multiply with 2 years of purchase. So your goodwill is 200,000 multiply with 2. So this is the amount of goodwill that you need to record in the books. So the goodwill that we have calculated, 200,000, will be distributed among the old partners and also the new partners. Okay, so using the old profit sharing ratio, so Zaidi, Zamani, and Zila using 334, so meaning that Zaidi would have 30% of the goodwill. Oops, sorry, forgot to put the sorry. And the Zamani is again with 30%. However, the Zila goodwill shared with 40%. So you can see that the total of the goodwill would become 200,000 using the old profit sharing ratio. But the new profit sharing ratio, even though in the example it doesn't state it, but we assume they share equally. Remember, Partnership Act section, I don't remember, the Partnership Act stated that if you do not have an agreement, the sharing will be equal. So on the credit side of goodwill account, so Zaidi, so they will share equally 25. So in the end, it should be have a balance of 0. So later on, in the partner's capital statement, you will credit 60,000 for Zaidi, and then you will debit 100,000 because it's dual entry rule. Okay, moving on to the next method, that is using the sharing ratio. Okay, using example, Candy and Sierra has been partners for 5 years, so they share profit and loss equally. So 50%, 50%. And then on 1st January, Arman, that is a new partner, joined the partnerships, and the capital contribution is 50,000 cash, and it says here 6,000 ringgit premium on Goodwill. And then they agreed for profit share ratio of 4:2, which means that 4 for Candy, 4 for Sierra, and 2 for Arman. So now how to calculate the total goodwill? So the new partner ratio is 2/10, right? Oops, we complete fish. Okay, 2/10. So your total goodwill, you need to make it in opposite. So the premium of the total goodwill will be premium goodwill paid multiply with the ratio, the opposite ratio. What is it? Terbalik. So it becomes 10 times 10 divide 2. So the premium is 6,000 multiplied with 10. You need to bracket them and divide by 2. So actually your total goodwill is 30,000. So this 30,000 will be shared among the Candy and Sierra. Okay, Candy and Sierra with a 50%. So debit the 30,000 multiplied with 50%. The same goes with Sierra. So you have 30,000 balance. And the new partners, you have 3 now. So Candy, Sierra, and Arman. So on the credit side of Goodwill account, this one, Candy shared a 40%. Oops, okay, forgot 0.4. The same with Sierra. However, the Arman on the share of 20%. Oops. Sorry, wrong formula. So the balance of Goodwill account again at the end of the preparation of Goodwill account should be 0, because you will not keep the Goodwill account, will not maintain the Goodwill account in the books. Okay. Now moving on. Now let's have a look an example, questions. Example questions. I will share with you later on what are the this file. Okay, let's say the example that we have here. We have 3 partners, Ahmad, Aida, Baba, and the partnership agreement is agreed that Ahmad is to receive salary 1,500, interest 10% per annum, and interest on drawing 4% per annum, and profit sharing ratio is 3:3:1. Okay, this we call the existing or the all profit sharing ratio, OPSR. And then this one is the data from financial statement last year. Okay, you have the carrying value of land, motor vehicle, features and fittings, and then you have a current asset, then equity. Now take a close look. The equity, in FAR160, we have capital account and add with net profit and deduct withdrawings. Remember? But in partners statement of financial positions, you have partners capital account and partners current account. You do not view anymore. I mean, you do not have the view of what is the net profit amount and the drawings amount, because all of those will be recorded in partners current account. Okay, the same as non-current liability and current liability. Only the changes on the equity part. Okay, let's say Baba, one of the partners, decided to retire on the 1st of June, and Badaria is a new partner, just joined on the same day. So once the new partner entered the partnerships, they have a new agreement. And this is we say as the new agreement. And look at the bottom of number 4, Roman 4. Profit and losses will be shared equally. Remember just now the old profit sharing ratio is 3-3-4. Remember 3-3-1. Sorry, 3-3-1 means that 3 for Ahmad, 3 for Aida, and 1 for Baba. But the new profit sharing ratio, the new profit sharing ratio is equal. So 1-1-1. 1/3, 1/3, 1/3 of each partners. Okay. It also has the new agreement says here Ahmad will receive 2,000 per month. We have a look upstairs. Okay, Ahmad received only 1,500. It increased to 2,000. No interest on capital. Just now capital is 10%. So the new agreement is none. Interest on drawing just now is 4%, I think. Then it increased to 6%. Okay, now in addition, Badaria contributed 50,000 of cash capital and 40,000 cash for her share of Goodwill. So actually, Badaria gave the business 90,000, but you need to show the difference. I mean, for capital per se and the premium or the share of Goodwill, even though those are the cash that's given to the business. And Badaria also brought a private van that worth 30,000. So this is affect your capital, partner's capital statement just later. Okay, then the additional information. Now this is when additional information to prepare your appropriation statement and also revaluation and also the Goodwill account. So the amount of Goodwill calculated as per share ratio means using the share ratio. And then these are the drawings made. And the third additional informations on the revaluing the asset. And you need to compare with the financial statement later, whether it's increase or decrease. Okay, and then the net profit for the year is 180,000. So it was assumed the profit is evenly accrued. So we just totally assume every month will be divided by 12. but in practicality, profit actually it's not true. It's not true evenly throughout the year, but we assume it's evenly throughout the year. Okay, then the question asked to do the revaluation statement and goodwill statement, appropriation statement, current statement, capital statement. So normally when we receive a question like this, I would suggest you do the appropriation statement first, then revaluation statement, goodwill, current or capital, whichever the same, boleh vice versa. Usually I will do capital statement first and last the current statement. Current statement first and last capital statement. Now let's do the work. So the appropriation statement, you need to divide into two columns. First column, we have pre, means that the pre of changes before the change, and we have post column, that is for after the change. Okay, now look into the questions. What date of the change? Here it says Baba decided to retire 1st of June and Badaria entered on the same day. Okay, 1st of June. So 1st of June, the appropriation statement that valid for pre, means that before changes, means from January to May. So January, February, March, April, May. So 5 months before the change. The 1st June is already changed. So your pre is 5 months. So 5 over 12. And the post is from June. So it's 7 over 12. 7 months. And pre is 5 months. This is very, 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 very important to identify what is the pre, what is the post. Pre months and post months. Always use your fingers. It says here 1 June. So the post must be starting from June. So June, July, August, September, October, November, December. So it's 7 months. Do not make mistake. That stupid mistake making you lost half of the mark later on. So do not make a mistake of pre months and post months. Calculate accurately. Okay, so the net profit, I'm sorry. Usually I already put the format of appropriation statement what are inside here. So the net profit is what is the net profit for the year? Okay. Yeah, here it says the net profit for the year, the December 2019. Oops, sorry. So the title should be 2019. Okay. And it's 180,000. So you need to divide this net profit according to the months. So this one is only 5 months. So 180,000 multiply with 5 and divide by 12. So only 75,000 profit for pre and 180,000 multiply with 7 divided by 12. So 105 for the post. So you need to divide these two columns, yeah. Okay, then let's have a look on the interest on drawings. You have just now, okay, this is other drawings, Ida and Baba. These are the three new partners. Okay, now Ahmad took 6,000 ringgit on 1st December. So December will fall into the post, right? Yeah. So your calculation for drawings for Ahmad is 6,000. That is the amount the Ahmad took, and the interest because December is on the post, so you must look into the new agreement. The new agreement says that interest on drawing will be increased to 6%. So the new agreement using 6%, and the time is 1/12 because it's for December. So you will not put in here because it's not applicable for pre. So it just black it out. So the amount of interest on drawing is on the post. So the post will be 6,000 multiplied with 6% and multiply with 1/12. So it's 30 ringgit. And Ida withdraw on the 31st May, 1,000 ringgit. So Ida withdraw 1,000 ringgit on 31st May. May means that 31st May, so you forward to the next month to calculate. So it becomes 1 June. So you start from June. Again, it will not apply for pre because June is already on the post. So again, you will use 6% rate, not the 4%, because 4% is only for pre. It starts from June, July, August, September, October, November, December. So it's 7 months. So 7/12. So again, blank in pre. So you put here the amount 1,000 ringgit multiply with 6% and multiply with 7/12. So 35 ringgit. However, Baba withdrew 4,000 ringgit on 28th of February. So 28th February is in pre. So 4,000 multiply with 4% multiply. Now from February, 28 February means that March. Okay, from March until May, because the 1st of June you are using the new agreement. So March, April, May, only 3 months. So 3/12 the time. So if Baba continue the partnership, so you need to add the 4,000 multiply with 6% and 7/12. If Baba is not retired, I mean continue exist as the partner, so the interest rate for drawings will continue for the post. However, here it says that Baba, in the question, Baba decided to retire on the 1st of June. So you cannot charge Baba interest on drawing because the 1st of June he already retired. So the calculation is only on pre, none in post. So the calculation is 4,000 multiplied with 4% and multiplied with 3 over 12. Just 40 ringgit. Okay, interest on loan, I didn't see any, so just leave it blank. So interest on capital, let's say interest on capital for Ahmad. Okay, the old agreement, interest on opening capital is 10%. So Ahmad, Aida, and Baba will receive interest on capital using the old agreement. So only on pre-column. And it says here 10% on opening balance. So Ahmad has 150,000. So okay, 150,000. Oops, kurang one. Okay, 150,000 the opening balance, and the rate is 10%, so 0.1, and you need to calculate the time from January to May, because the 1st of June you already changed the agreement. No interest to capital anymore. So only 5 months. So 5 over 12. The same goes to Aida, 130,000 of her contributions, opening balance of capital. Okay, then multiply with 10% and multiply with 5 over 12. Okay, the same goes to Baba. The interest on capital is 120,000. 120,000. Okay, and multiply with 10% and multiply with 5 over 12. Post, there is no interest on capital. So if there is a interest on capital, then you need to calculate calculate for that particular interest on capital. But in the question, no, doesn't say. Okay, and salary. Okay, salary is all for Ahmad, because Ahmad received the old one. It's 150,000. So Ahmad has a salary for pre 150,000. Okay, 150,000. No, 1,500 for 5 months. January to May. So multiply with 5. And however, Ahmad will receive 2,000 according to the new agreement. So 2,000 multiply with 7, because that is the post in the post column. Then you will have the profit available for appropriations. Yeah, the the root is okay. So we need to have the interest on drawing report. She checked. Again, you need to have to less 15, another 16, right? Oh, sorry. No, really 16 and okay. You need to check all the you calculate correctly. Okay, so you okay, correct. And this one again, okay, you taking account all the data at the G8 and the G9. Okay, right. So you confidence is correct. So you have three the old partners and the new one. But yeah, but that is nothing here because it's not applicable at all. Okay, because Badaria do Badaria do not make any drawing. Okay, and there is no interest on capital allowed. So there's no interest on loan and so on. So Badaria will not be recorded any record up here. So only on the profit sharing. So profit sharing, the old one, if using the old profit sharing ratio, Ahmad is 3T1. All right, so 3/7. And the new one, is shared equally, so 1/3. Okay. See Ida. Again, Ida also the same with Ahmad. But Baba, the only using the old one. So 1/7. No new, because Baba is already retired. Okay, so however, Badaria, no old, because it's only new. So 1/3. So I just write it down because I'm making sure that the profit sharing calculation is correct. So if using the old one, so means that using the pre column of profit available for appropriation, and multiply with 3/7. Okay, the same goes with Ida. Okay, multiply 3/7. However, Baba is the profit for pre multiply with 1/7. So if you calculate the total, should be the same with the profit available for ratio. Okay, 61706.7. And the new, but I don't know because it's she's new. So the profit sharing with the new agreement of profit ratio is using the profit available for appropriations in the post column and multiply with 1/3. The same goes with Ida. Multiply 1/3. Baba will not receive any because it was already retired in this period. And the Badaria, profit available positions, multiply with 1/3. So the amount should be the same with that profit available for appreciations. So okay. continue with our preparing answer for the questions. The next to prepare is the revaluation account, or you may prepare the goodwill account first, doesn't matter. Okay, the date of the changes is the 1st of May. Okay. Let's have a look. I think it's 1st of May. So just put May 1st. Okay. May 1st, not May 1st, June 1st. June 1st. Okay. So the evaluations, you can see additional information. The sums asset were revalued here. Additional information number 3. So land becomes 430. So the new value is 430, and the carrying value, you can see inside the statement of financial positions. All right. So the carrying value is 330,000, but the new value is 430. So there is an increase. There is an increase of land. So you put land in the valuation account. So you put at credit side, because you will debit land account and credit revaluation account. So 100,000, because the carrying value is 330. Now the new value, or the new value is 430,000. So you credit 100,000 for land, particular land. And the next one is motor vehicles. The new value is 80. Okay, the carrying value is 100. So motor vehicles, your motor vehicles has been reduced the amount of 20,000. So 20,000 here on the debit side, right, because it's going to decrease. And fixtures and fittings, fixtures and fittings. Okay, the new value is 36,000, and the old value is 65,000. So 65 is more than, so there is a decrease in value, 65. So 19,000. Am I correct? Okay, sorry. The amount should be 29,000. Okay, so 29,000 decrease in value of fixtures and fittings. So again, you need to calculate the balances so that you know what, if there is a surplus, or actually there is a shortage of the value of the asset. Okay, wrong formula, sorry. 10,000 plus this one and minus this one. Okay. So when you calculate, there is a surplus amount of 51,000 when you revalue the asset. So you will transfer, divide. You will divide this the surplus from the revaluation account to the partners that that exist, but the partners only for the existing one, not the new one. So you will distribute the Ahmad, Aida, and Baba, because Badaria does not belong to that this particular period. So they are not entitled. Badaria is not entitled for the revaluations surplus. Okay, let me have this. And the since that it's a surplus, so you need to put on the debit side, because at the end of the account, the balance should be 0. Okay, so Ahmad, using the old partners share ratio, this is that is 3/7. So the surplus multiply with 3/7, and the same goes with Ida. The surplus multiply with 3/7. However, the Baba is only 1/7. So you can making sure that you are calculated it correctly. So then the balance is 0. So your revaluation is already there. Okay, next is goodwill account. Okay, goodwill account, it says that the amount of goodwill will be calculated as per share ratio. Okay, per share ratio means that you will look into the premium. So the formula, okay, let me, this is, okay, so the premium paid by the new on the new partner is okay, put here 40,000, right? 40,000. So the total of goodwill, if you're using ratio, okay, and this amount is actually 1/3, right? Because they share profit in share is 1/3. So, oh, sorry, always forgot about that. 3. So the total goodwill, the formula is, okay, the premium paid multiply with the total ratio, means that times 3 and divide by 1, because just now the ratio is 1/3, right? So times 3 divided by 1, so it's 120,000. So the total goodwill is 120,000. So Ahmad, Ida, and Baba, that is the old partners. And the new partner ratio, Ahmad, Ida, and the new one is Bada, yeah, because Baba is no longer in the picture. So the amount is, right, you will the amount that we calculate just now is 120,000. Okay, and multiply with the old ratio is 3/7. Oops, Ida is the same, but Baba not. Sorry. Okay, so Baba, but not 3/7. Oops, sorry. 120,000 multiplied with 1/7. So total is 120. Okay, these two should be number 2 decimal point, and the total goodwill should be shared among the new partners. Okay, so you again is 120,000. Oops, forgot. Closing, multiply with 1/3. Okay, what's wrong with the formula? Right. So you make sure that at the end of the goodwill account should be 0, because we redistribute the goodwill with the new partners and the old partners. Okay, next. Oh, forgot on the date. You can put the date. Oh, you do not want to put the date, then it's fine, because it's, of course, it's June 1. But the valuation then will occur at the beginning of the changes. Okay, next. So partners current account. You have another one. It's Badaria, right? So you have Ahmad, Aida, and you have Baba, and you have another one, Badaria. Okay, balance of current statement. You can look into the statement of financial positions. The partner's current account for Ahmad is 40,000. So okay, 40,000. Aida is 20,000. And Baba is 30,000. Badaria do not have any. Okay. And interest on capital, then you can look if there is an interest on capital for Ahmad. Yes, there is. And do you have accrued salary? No, you do not have accrued salary. It's 0. Appropriate profit. Wait. Let's settle for the interest on capital first. Interest capital of Aida. Interest capital for Baba. Okay, Badaria do not have, because the interest is only on the beginning of capital, and new agreement, there is no interest on capital. Okay, so accrued salary is 0, 0, and 0. Appropriate profit, this one. If Ahmad has the old one, and also you have a new one. And also the same goes with Aida. You have old agreement sharing ratio, and you have a new agreement sharing ratio. But Baba only have the old agreement, and Badaria only have the new agreement sharing ratio. Okay, interest on drawing for Ahmad. Ahmad has the total of 30. Aida has 35. And Baba has 40. Okay. Badaria do not have any, and no drawings also. Okay. Do not forget to put the drawings amount. Okay. So go back to the questions. Drawings amount of has been made by Ahmad is 6,000. Oops. I think I forgot. Ahmad has made the 2 drawings. One, the 1st December, and also 30th June. I forgot this one. Okay. 30th June means that start from July. So in the post, at the post. So 1st December and 30th June. So you need to add another one. Okay. That is 2000 multiply with 06 multiply with July, August. So it's 6 months, right? 6/12. How can I forgot? I didn't even see that. Okay, but never mind. We can still adjust it. Okay, because you have two drawings. Okay, back to the answer. Using Excel, so it's automatically calculated. Never mind. Okay, next. See, just a drawing is 90. Okay, the drawing should be 6 plus 2, 6,000 plus 2,000. So it's 8, and Ida 1,000, and Baba 4,000. Okay. So when you calculate this, you have a surplus. Baba has a surplus of 39,000. Okay, so if you have a surplus, this surplus should be transferred to partner's capital account. Well, interest on loan is 0. There is no interest on loan. So you need to transfer partner's capital account. Since Baba is retiring, means that all the surplus of the current statement should be transferred to the capital account, so that you can pay out the capital to the partner. So you can calculate what should be for the positive amount. Oops, sorry. And deduct interest on drawing, deduct drawing. So this is the amount. So this amount, oops, plus, deduct. So your answer at the end of partner's current statement for Baba should be 0, because we will transfer this to Baba capital account. Okay, this is less, then you need to add. At the partner's current statement. So at the partner's capital statement for Baba, you need to add, this is the amount and you put here. So this 39775.24, you will put at the end, adding up the capital, because we need to pay Baba is 39,775.24 cents. This is the balance. I mean, the still the balance of current statement that we should pay to Baba. Okay, so the information for the capital. So the balance. Okay, the balance of capital account. Ahmad is 150,000. Ida is 130,000. That's the capital. Is then Baba is 120,000, and Badaria do not have any opening balance because she's new, but she already she has a contribute of 50,000 of cash, and the 40,000 still in cash, but we separated 40,000 for premium of Goodwill. Now, in capital statement or capital account, you need to record the Goodwill. Remember, we do the Goodwill account. So you have here debit Goodwill account, and then you will credit the capital account. Credit capital account means add, tambah. Okay, so Goodwill with the all profit sharing ratio, Ahmad, and also Ida. Oops, Ida and Baba. And Goodwill with new profit sharing ratio is on the debit side, means the less. So Ahmad, Ida. Oops. Did I wrongly taking? Okay, it should be here. 40,000, not that one. Oops, Baba, no. The Goodwill for Baba will not be recorded because Baba is already retired for with the new agreement. Okay, now the revaluations surplus. Okay, remember the surplus that we redistribute to the old partner, not the new partner, but the new partner. So the distributions, Ahmad, Ida, Baba. So Ahmad distribution of surplus, Ida and Baba. Badaria do not have the revaluation surplus, and also Goodwill for with the old profit sharing ratio. Badaria only has this one, and Goodwill this one for Baba is 0. So then you will calculate the balance carry down. So the balance carry down, the add Oh, I nearly forgot. Wait. Contribution of Badaria is 50,000 cash or capital, 40,000 cash for Goodwill, and she brought the private van. Okay, I forgot that one. So just insert. You have vehicle, motor vehicle. Okay, motor vehicle, or the amount is 30,000. Okay, now then this one is more or less the same. Ida is more or less the same with Ahmad. Baba, only that Baba. Did I correctly? Wait, I think we missed something. Revaluation surplus D71 there. Forgot that one. D71 plus D71. Now we have all the colors. And also it's 69. Okay, this more this here. I work this one. Okay, this amount is 184,203. This actually should be paid to the partners because Baba is retiring. So actually 184,203.81 should be on the less. So you put here cash at bank because we will do the bank transfer to pay the balance that we owe to Baba. So in this one we should deduct, and the balance of carry down of Baba must be 0. Okay, now have a look for Badaria. 10,000. So the balance of carry down capital segment, last one is Badaria, is 80,000. So that's it. Because we already complete the revaluation statement, goodwill statement, appropriation statement, current statement, and capital statement. Okay, that's all for now for the video. Thank you for watching. Watch out for the next video on the next video for the next topic. Bye bye.